6 vessels. Hold that number before a single price chart enters the conversation. Within a 12-hour window this past week, maritime tracking data documented exactly 6 ships crossing the Strait of Hormuz, a corridor that earlier in the same month was still processing somewhere between 18 and 20. 2 transits daily. Approximately 1/5 of the petroleum that keeps the global economy functioning passes through that 21-mile passage. And this week, it went silent. Not empty, silent. The variety of silence that carries a direct financial cost. And based on careful analysis, the variety of silence that accounts for nearly everything happening to the metal you came here to discuss. This analysis will not open with a silver chart. It will not open with a Federal Reserve announcement. Because if you want to understand where silver is trading this morning, the chart is not where the explanation resides. The explanation is drifting somewhere in the Gulf of Oman, waiting for clearance to proceed. Every technical level, every institutional forecast, every price target discussed here is downstream of those 6 ships. Follow that thread, and the entire week assembles itself into something approaching coherence. Here is where the market actually stands as of the morning of July 14th, verified against current spot data rather than prior session screenshots. Silver is trading in the upper $50 range, around $58.50 per ounce, having slipped below $60 late last week and reaching as low as the high 57s before buyers reportedly re-entered. Over the trailing month, silver has declined in the mid-teens on a percentage basis. Over the trailing 12 months, it remains higher by more than half. Both statements are simultaneously accurate, and the ability to hold both without either panic or complacency already represents clearer reasoning than most market commentary provides. Gold tells a parallel story in a lower register. It shed approximately 2% in Monday's session, its worst single-day performance in over a month, before recovering a portion of that loss to trade near $420 per ounce this morning. A partial recovery that owes more to profit-taking on an extended dollar position than to any genuine resolution of underlying tensions. Both metals are experiencing what markets describe as corrective pressure, and the gold-to-silver ratio currently sits near 68, meaning approximately 68 ounces of silver are required to purchase 1 ounce of gold. Remember that figure. It becomes relevant later. So why is silver near $58 while an active military conflict escalates across the single waterway responsible for moving 1/5 of the world's petroleum supply? In a market environment where retail participants have absorbed for decades the conventional wisdom that conflict sends metals higher, this is precisely where most analysis either misrepresents the situation or simply recycles assumptions that were never examined carefully. Conflict means metals higher. Uncertainty means metals higher. And when the price does the precise opposite, the response is usually vague references to market manipulation followed by a change of subject. A more useful approach is to trace the actual mechanism, link by link, because once the chain is visible, it cannot be unseen. And the next time silver declines on a war headline, the response will be understanding rather than surprise. First link. Over the weekend, the United States conducted what has been described as its 4th strike against Iran within a single week, in response to an Iranian attack on a Cyprus-flagged vessel transiting the strait. Iran responded with missiles and drones directed at American positions across the Gulf region. Tehran declared the Hormuz passage closed until further notice, a claim U.S. Central Command formally disputes. 2 governments, 2 contradictory versions of operational reality, 1 waterway, and shipping traffic collapsing while military commands argue past each other in public. Second link, oil does not arbitrate between competing government statements. Oil responds to barrels that physically move. Brent crude has advanced sharply on the escalation, trading in the upper 70s to $80 range, with multiple trading desks reporting intraday spikes meaningfully above that level as closure headlines circulated, representing a rise of roughly 4 to 9%, depending on which session provides the reference point. Simultaneously, the U.S. Treasury has reportedly withdrawn its sanctions waiver on Iranian petroleum, with the effective date landing this week, eliminating barrels the market had already incorporated into its supply calculations. Third link, and this is where the situation turns against silver specifically. Petroleum is an input into virtually everything manufactured, transported, or delivered anywhere on Earth. When oil prices rise, inflation expectations rise in advance and markets price that expectation long before it registers in any official statistical release. Fourth link, the Federal Reserve carries one overriding institutional concern, and that concern is inflation. The federal funds rate currently sits at 3.50 to 3.75%. The Fed's own June projections, the first issued under new Chairman Kevin Warsh, elevated this year's headline inflation forecast to approximately 3.6%, substantially above earlier estimates. Minutes from that meeting reportedly documented a meaningful contingent of officials already advocating for a rate increase at that very session. The committee held, but communicated clearly that additional tightening remains available if inflation persists. Fifth link, the one that directly moves the price. Markets are currently pricing somewhere in the range of 65 to 75% probability of a Federal Reserve rate increase by September. Estimates vary by source and shift by the hour, but the directional trend through the week has been consistently higher. The arithmetic runs automatically across every professional trading operation. Silver generates no coupon, no dividend, not a single cent of income for holding it. When the anticipated return on cash and fixed income instruments rises, the opportunity cost of holding a metal that produces nothing rises with it. Capital exits, not because of coordinated manipulation, but because a portfolio manager somewhere ran the identical calculation just described, and the calculation indicated the same conclusion. That is the complete chain. 6 ships to oil near $80 to inflation, concern to a more aggressive Federal Reserve posture, to rising rate increase probability, to a stronger dollar, to silver declining below 60. Conflict did not lift silver this month. Conflict routed itself through petroleum markets, and the petroleum market delivered the Federal Reserve a justification for sustained restrictiveness. A restrictive Federal Reserve is the most reliable adversary a non-yielding metal has historically encountered. That is not a conspiracy. It is plumbing, unglamorous, and indifferent to any particular narrative. Now, the development that deserves attention that has not received it adequately elsewhere. This morning, July 14th, at 8:30 Eastern, the Bureau of Labor Statistics releases the Consumer Price Index for June. 90 minutes later, Kevin Warsh appears before the House Financial Services Committee for his inaugural congressional testimony as Fed chairman. He returns the following day before the Senate Banking Committee, shortly before the Producer Price Index is also released. 3 market-moving events compressed into 48 hours, with an active military escalation operating in the background. This is not a standard week. It is a pressure environment with observable stress already present. Here is the analytical wrinkle that most commentary has not addressed. Economists broadly anticipate this morning's inflation report to arrive soft, genuinely soft. Consensus, based on review of major forecasting surveys, points to headline inflation declining to somewhere between 3.8 and 3.9% year over year, down from 4.2% in May, with the monthly figure possibly registering negative for the first time in years, and core inflation holding near 2.8 to 2.9%. On the surface, that headline figure is constructive for silver. Moderating inflation could indicate a Federal Reserve with reduced motivation to raise rates, implying lower expected future rates, reduced cost of holding a non-yielding metal, and silver should theoretically appreciate on that data. But the question almost no one is posing deserves to be asked directly. Why is June inflation expected to be this moderate? Because June was the month oil collapsed. Midway through that month, Washington and Tehran reportedly signed a memorandum of understanding. Military activity paused. Ships resumed movement through the strait, and crude prices declined sharply back toward pre-escalation levels. Fuel costs decreased. Energy dragged the entire consumer price index lower with it. By certain estimates, the decline in gasoline prices alone could subtract several tenths of a percentage point from the headline figure. That is the complete explanation for the favorable data expected this morning. And that ceasefire no longer exists. It broke down last week and is being formally buried this week, with multiple American military strikes occurring within days, and a strait Tehran insists remains closed to navigation. Consider what that means carefully. The inflation report landing this morning is a photograph of a world that has ceased to exist. It captures a peaceful June, developed and processed in the middle of a deteriorating July. Markets may respond to that photograph as though it represents a live data feed. It does not. The new oil price shock that began approximately 9 days ago has not registered in this data at all. Not a single basis point of impact. It will not appear until the July inflation report, which is not scheduled for release until the middle of August. That gap creates one of the more hazardous patterns this market generates with some regularity. A relief advance constructed on outdated information. Silver could move higher this morning on a moderate inflation print, and market participants could conclude the Federal Reserve is constrained from acting. All of it built on a number that measured conditions that no longer exist. Watch the producer price index tomorrow morning more carefully than the consumer number today. Producer prices sit further upstream in the supply chain, closer to raw energy inputs. That is where a fresh petroleum shock registers first. If consumer prices arrive moderate while producer prices arrive elevated, that divergence represents the actual story for the following month, and very few analysts will be focusing on it. That is also why congressional testimony may matter more than either statistical release. Kevin Warsh is not a conventional central bank chairman. His brief tenure has been characterized by what appears to be a deliberate dismantling of the practice of forward guidance itself, on the reasoning that central banks became dependent on signaling and constrained by their own prior commitments. He declined to submit a projection to the June dot plot. He left that entry blank. The chairman of the Federal Reserve declined to communicate to markets where he believes interest rates are headed. When he appears before Congress this morning, do not anticipate a policy commitment, because the probability of receiving one is low. Listen instead for how he characterizes the oil price shock. Does he describe it as transitory, temporary, or one-time in nature? Or does he describe it as persistent and broadening? Those specific adjectives may constitute the entirety of the meaningful signal. One set implies the Fed looks through the war's inflationary impact. The other implies a September rate increase is being actively prepared. Silver may trade on his word choices more than his numerical projections, and the majority of retail participants will not be listening for that distinction. This analysis gives you the framework to do so. The most structurally significant element of this entire week, for the first time, according to those June meeting minutes, Federal Reserve officials reportedly incorporated artificial intelligence infrastructure investment directly into their inflation analysis, not as a productivity narrative, but as an inflationary risk factor. The New York Fed president has stated publicly that of all the demand-side factors currently influencing prices, the one commanding closest attention is consumption driven by artificial intelligence investment. The Federal Reserve's own analytical materials have identified semiconductor and data center component demand as a source of price pressure. The implications for silver deserve explicit statement. The artificial intelligence build-out represents arguably the single most powerful structural demand argument in the entire silver investment thesis. Every server rack, every power management system, every solar installation supplying those data centers consumes silver, the most electrically conductive metal commercially available with no viable large-scale substitute. That demand pathway is why serious analysts discuss triple-digit silver as a plausible long-term outcome rather than speculation. And that exact same build-out is now being cited by the central bank as justification for maintaining elevated rates for an extended period, which suppresses silver's price in the near term. Silver's most powerful long-term demand driver has become its most effective short-term price suppressant. That is not a logical contradiction. It is a timeline distinction. Industrial demand accumulates in physical metal consumed across years. Rate expectations register in paper silver prices within seconds. In competition between years and seconds, seconds determine the outcome of any given week. Years determine the outcome of any given decade. On the paper side of the market, the current picture is unflattering. Silver-backed exchange-traded fund holdings have reportedly declined by tens of millions of ounces in recent weeks. Speculative futures positioning has contracted meaningfully, and multiple banking institutions have reduced near-term price targets. The price chart is registering lower highs and lower lows, the technical signature of a declining trend, with momentum indicators positioned below neutral, suggesting the modest recovery from the high 50s appears corrective rather than the initiation of a genuine trend reversal. The physical market tells a different story, and almost no one watching a price chart takes the time to examine it. The silver market is tracking toward its sixth consecutive annual supply shortfall, 6 straight years of global consumption exceeding global production. This year's projected deficit, according to the Silver Institute, sits near 46 million ounces, and several hundred million ounces have reportedly been drawn from above-ground stockpiles since 2021 to satisfy that cumulative gap. That is not a projection. That is metal that has already departed vault storage and will not be returning. The structural characteristic that distinguishes silver from most other commodities deserves emphasis. More than 70% of global silver supply arrives as a byproduct of copper, lead, zinc, and gold extraction. Only a modest fraction of total supply is genuinely price responsive in the conventional sense, meaning if silver prices doubled tomorrow, the world could not simply respond by producing proportionally more. Most silver supply answers to the economics of someone else's copper operation, not to silver's own price signal. That is why deficits in this market do not self-correct through conventional commodity market mechanisms, and why physical supply tightness compounds gradually year after year, while the price responds to whatever interest rate positioning traders determine is appropriate for any given month. The paper and physical markets are simultaneously moving in opposite directions within the same metal. Those two dynamics cannot coexist indefinitely. Eventually, one overcomes the other. The decade-scale outcome and the week-scale outcome are currently different answers to the same question. Where does the price go from current levels? Here is an honest level-by-level framework, so the market can be monitored directly rather than waiting for retrospective narration. On the downside, the zone that has attracted buyers is roughly $57.50 to $58 $, a convincing close below that range, particularly on a hot inflation surprise or aggressively hawkish congressional testimony, opens the path toward the mid-50s. A genuine capitulation flush could, based on structural analysis, carry the price into the low 50s before finding durable support, That outcome is not a prediction. It is a scenario that exists on the probability map, and dismissing it as impossible serves no analytical purpose. On the upside, the first meaningful resistance sits near the 21-day moving average, somewhere around $61 to $62. Above that sits a descending trend line that has contained every recovery attempt since prices peaked in the low to mid-60s. The more significant resistance, the structural barrier, sits where the 50-day and 200-day moving averages reportedly converge, somewhere between $69 and $71. Until silver reclaims that zone,